Welcome to the Deep Dive. Today, we're really getting into the weeds on Gravita India Ltd. We spent a lot of time with their Q2 and H1 FY26 earnings call, their investor decks, and honestly, it paints a picture of a company that's, well, really transforming itself right now. Our goal here is to unpack how this major global recycler is managing some seriously aggressive growth targets. I mean, doubling capacity is huge. And at the same time, they're shifting into totally new areas. Think lithium ion, rubber recycling. Plus, they're navigating a whole new regulatory landscape. So lots to cover.
Absolutely. And it's crucial because Gravita isn't small. We're talking about a company with, what, a 30-year history, operating in over 70 countries. So when they make big strategic moves like this, doubling down, it really signals where the wider recycling industry might be heading. It's significant.
Okay, let's start where you usually do the financials. The scorecard for the first half of FY26. What jumped out?
Well, the headline numbers are strong, definitely. Consolidated revenue for H1 FY26 hit 2,075 crores. That's up about 13% year-on-year. Solid growth. But the real story, I think, is in the profitability.
Oh, okay, go on.
The profit after tax, the PAT, didn't just grow 13%. It shot up 36% year-on-year. Came in 189 crores.
36%. Okay, that's way more leverage than just the revenue growth. Suggests they're managing costs or getting better margins, right?
Exactly. Better margin capture. Adjusted EBITDA saw a similar trend, up 16% to around 223 crores. And if you look just at Q2, the second quarter, it's the same pattern. 12% revenue growth, but boom, 33% FIGQ growth. And importantly, their EBITDA margins stayed really stable, around 10.8% for both H1 and Q2.
Right, stability even with commodity prices doing their thing. That shows control.
It does. And it signals pretty strong operational efficiency.
And they mentioned ROIC, return on invested capital, too. How did that look?
Very healthy. For H1, they reported an ROIC of 26%. So yeah, the capital they're deploying seems to be working hard for them.
Okay, so the financial base is strong. But this massive growth plan needs capacity. They're currently at, what, 3.4 lakh metric tons per year?
Yeah, 3.4 lakh MTPA is the current installed capacity. But hold on to that number, because under their Vision 2029 plan, they're aiming for over 7 lakh MTPA by FY28.
7 lakh. Wow. Okay, so more than double.
More than double. It's a massive scale up.
That sounds incredibly capital intensive, doubling physical footprint.
Surely the CapEx budget must be through the roof. Is that going to hurt their return?
Well, that's actually one of the most interesting strategic shifts we found in the materials. Their earlier CapEx plans were bigger, but they've actually revised the total spend down to about 225 crores by FY28.
But they're still aiming for the same 7 lakh ton target. How does that work? Double the capacity for less money than originally planned.
It works because they changed how they're expanding. They made a clear strategic choice about the focus on brownfield expansion, not greenfield.
Ah, okay. So expanding existing sites rather than building brand new ones from scratch. Precisely. Greenfield means buying land, getting all new permits, building everything. It's slow, expensive, and frankly riskier. By focusing on beefing up their existing plants, they mentioned Mundra and Phagi, specifically, they get more bang for their buck. Lower capital cost per ton of new capacity. It's a smart capital efficiency play.
Yeah, that makes a lot of sense. Leverage what you already have, less risk, faster execution probably too.
Definitely. And look at the budget breakdown. About 850 crores of that 1,225 crore total is earmarked for strengthening their current core verticals. The rest, that remaining chunk, is specifically tagged for funding the diversification. Which brings us neatly to the next big theme.
Right, the shift beyond just lead recycling, this seems core to their Vision 2029. Two big targets there, right? First, value-added products, VAPs.
They want VAPs to contribute over 50% of their total revenue. They're actually pretty close already. H1 FY26 saw VAPs at 47%.
And just to clarify for listeners, VAPs aren't just standard recycled lead ingots, are they?
No, exactly. Think specialized lead alloys, specific oxide compounds, stuff tailored for battery makers or other industrial uses. Higher spec, higher margin.
Got it. And the second target, that feels like the bigger leap.
It is. They're aiming for the non-lead segments, aluminum, plastic, rubber, lithium ion, to contribute over 30% of total revenue.
30%. That's fundamentally changing the shape of the company, from lead-centric to much more diversified.
Fundamentally. And the timeline they've laid out is quite aggressive. If you look at the planned capacity mix for FY28, it really shows you where the growth engine is supposed to be.
Okay, let's see that breakdown. Where's the new capacity coming from to hit that 30% non-lead target?
So lead will still be the biggest chunk, around 450,000 tons. But then you've got aluminum planned for 70,000 tons, plastic at 50,000 tons, Rubber is a big one, 100,000 tons. And the really interesting one, lithium-ion, starting with about 30,000 tons capacity.
Okay, so sizable chunks across the board.
Yeah,
And when do these new lines actually start producing?
it's happening now, basically. The lithium-ion pilot plant in Mundra, that's supposed to be operational this quarter, Q3 FY26. And the rubber project, also Mundra, is expected to commission in Q4 FY26, with revenues kicking in from FY27. They also mentioned stabilizing a rubber facility in Romania.
So the diversification isn't just talk, the capacity is literally coming online as we speak.
Exactly. Though they did mention paper and steel recycling too.
Right, I saw that. But those are more maybe later projects.
Correct. The sources state those are potential future greenfield ideas, but they're not included in that 7 lakh MTPA target for FY28. And importantly, no capex is committed yet, at least not through the first half of next year.
Okay, so focus is on lead, aluminum, plastic, rubber, and Lion for now.
That's the plan. Get these 5 running smoothly first.
All right, let's dig into operations a bit more, specifically margins and volumes, because there was something interesting there. If they're expanding and diversifying so much, why did consolidated volumes only grow 4% year-on-year in Q2? Seems a bit low given the momentum.
Yeah, that 4% number does stand out, doesn't it? Management actually addressed this directly in the call. It seems it was a conscious decision driven by profitability. They talked about an arbitrage strategy.
Arbitrage, how so?
Basically, sourcing material overseas, but then selling it within India where they could get better prices. This strategy apparently allowed them to capture really good margins. Remember that lead EBITDA per ton was very high, 23,196 in Q2.
Ah, okay. So they sacrificed some headline volume growth to maximize the margin on the volumes they did sell.
Precisely. Margin over sheer volume, at least for that quarter. It fits with them upgrading their sustainable lead margin guidance to up to 19.20 per kilo. They seem confident in holding those better margins.
Makes sense. Was there anything else impacting Q2 volumes?
Yes, they also mentioned a bit of a market disruption. Apparently there was anticipation of a GST cut on batteries, so trade partners held back inventory, waiting to see what happened. They estimated this caused maybe a 5% to 8% dip in volume for the quarter, which they expect to bounce back.
Right, temporary market jitters.
Uh-huh.
Okay. Now, a huge factor underpinning all this expansion has to be sourcing the raw materials, the scrap. And the government's new rules, the Battery Waste Management Rules, BWMR, and the EPR framework seem absolutely critical here.
Oh, fundamental. You can't overstate the impact. These policies are essentially designed to formalize waste collection. They aim to stop scrap leaking into the unorganized, informal sector and channel it towards registered recyclers like Gravita.
And is it working? Are they seeing more domestic scrap?
The numbers they shared were quite dramatic. In Q2, their domestic procurement of used lead batteries was up 35% compared to the previous year.
35% increase in domestic sourcing year on year. That's a huge shift.
It's a radical shift. It's completely changed their sourcing mix for the Indian plants. Last year, it was roughly 36% domestic scrap, 64% imported. Now, it's flipped to about 52% domestic, 48% imported, a near-perfect balance.
Wow. So the policy is actually delivering more raw material domestically.
It seems to be. And management sounded quite confident that raw material availability won't be a constraint for their expansion plans going forward. They pointed out that currently, only about 35% of all the scrap generated in India actually makes it to the organized sector.
So the other 65%, that's the potential pool unlocked by these rules.
Exactly. That 65% currently handled by the unorganized sector is the massive opportunity these policies are trying to tap into. It represents huge potential supply.
It's like the policy itself is creating a supply tailwind for companies like Gravita.
That's a good way to put it.
Yeah.
But there is one snag, one bottleneck that came up, specifically relating to their aluminum plans.
Okay, what's that?
It's about hedging. They're basically waiting, quite actively it seems, for the multi-commodity exchange, the MCX, to finally launch aluminum futures trading and a proper hedging mechanism in India.
And they need this hedging. Why? Why is it so important for aluminum?
Because aluminum recycling margins, especially domestically in India, can be quite thin and volatile without hedging. They estimate sustainable margins could be around 12-14 per kilo if hedging is available. But think about their strategy. They want to scale up aluminum significantly, which eventually means selling to big automotive OEMs.
Right, and getting those OEM approvals takes time. Lots of testing, quality checks, long sales cycles.
Exactly. It's a tough process. The beauty of an MCX hedging mechanism is that it would give them a ready market, before they secure all those OEM contracts. They could produce high-quality aluminum alloy like ADC12, and if an OEM deal isn't finalized, they could sell it directly on the exchange, locking in a price.
Ah, so it de-risks the production ramp-up. They can build the capacity and sell profitably even while they work on landing the long-term OEM deals.
Precisely. It smooths out the volatility and removes a major barrier to scaling up their domestic aluminum recycling profitably. But right now, that mechanism isn't live yet. They said documentation is done, approvals are in place internally, but they're still waiting on the MCX.
Okay, so that's a key dependency to watch for their aluminum ambitions.
Exactly.
All right, so let's try and pull this all together. If you step back, the picture of Gravita seems to be one of quite successful execution on a really complex plan. They're moving decisively from being primarily a lead recycler to a much broader integrated player across multiple materials. And they're funding this massive capacity expansion smartly using brownfield efficiencies to keep CapEx under control.
That's the core narrative, yes. They're managing growth, diversification, and capital allocation pretty effectively based on these results and plans. But, so much of the future growth, especially the domestic piece,
Yeah.
seems heavily reliant on that policy tailwind we discussed,
Yeah.
the formalization of scrap collection.
Right, that shift of the 65% from the unorganized sector.
Exactly. They're betting heavily that the government's policies will effectively push that scrap towards them over the next, say, 2 to 3 years. Now, they do have their global sourcing network as a backup. Those 33 yards, nearly 2,000 touch points worldwide, give them options.
But the big domestic scale-up really banks on that formalization happening efficiently. So maybe the final thought to leave you, the listener, with is this. How quickly can that formalization realistically happen? Is Gravita's bet on the speed of that policy-driven supply shift going to pay off on their timeline? Or will their international sourcing strength need to carry more of the weight for longer than they currently anticipate? That pace of domestic formalization feels like the key variable for their near-term future.